Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about General Dynamics Corporation Annual Report. General Dynamics Corporation offers a diverse range of businesses and services across four segments: aerospace, marine systems, combat systems, and technologies. The aerospace segment provides business jets, aircraft maintenance and repair, management, and custom completion services. This includes modifications, upgrades, and lifecycle sustainment support services for various aircraft. In the marine systems segment, General Dynamics designs and builds nuclear-powered submarines, surface combatants, and auxiliary ships for the U.S. Navy and commercial customers. They also offer maintenance, modernization, and lifecycle support services for Navy ships. The combat systems segment manufactures land combat solutions, such as wheeled and tracked combat vehicles, main battle tanks, and armored vehicles. This segment also offers modernization programs, support and sustainment services, and development programs. Lastly, the technology segment provides information technology solutions and mission support services, including mobile communication, computers, and command and control mission systems. They also offer intelligence, surveillance, and reconnaissance solutions to military, intelligence, and federal civilian customers, as well as cloud services, cybersecurity, network modernization, artificial intelligence, machine learning, application development, high-performance computing, and 5G and advanced communication services. In addition, General Dynamics offers unmanned undersea vehicle manufacturing and assembly services. The recent surge in General Dynamics Corp's stock price can be attributed to several key factors that have contributed to its impressive 34.55% increase over the past year. One major driver has been the company's strong earnings performance, which has consistently exceeded analyst expectations. In Q4 2025, General Dynamics reported $4.17 earnings per share, EPS, surpassing estimates of $4.11 and marking a significant revenue growth of 7.8% year-over-year. In addition to its robust financials, the company's stock price has also been buoyed by positive analyst ratings and price target increases from leading financial firms. Several institutions, including Argus, Bank of America, Wolfe Research, Susquehanna, and Jefferies, have issued optimistic outlooks for General Dynamics, with many raising their target prices to reflect the company's growing earnings potential. Furthermore, the company's commitment to shareholder value has been evident through its dividend announcements. In January 2026, General Dynamics declared a quarterly dividend of $1.50 per share, representing a $6 annualized dividend and a yield of 1.7%. This move is likely to have contributed to investor confidence in the company's financial stability. Lastly, favorable valuation metrics have also played a role in driving up General Dynamics' stock price. Despite trading at a relatively low trailing P/E ratio of 22.9x compared to its industry average of 42.2x, the company has demonstrated ongoing earnings growth and an impressive 8% margin. Forecasts suggest that this trend is likely to continue, with annual earnings growth projected at approximately 7.6% and revenue growth of about 3.5%. These metrics highlight General Dynamics as a potentially undervalued stock with consistent performance, making it an attractive investment opportunity for many investors. General Dynamics Corporation market capitalization of $95 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that General Dynamics Corporation holds a significant advantage in their industry. General Dynamics Corporation trades at a lower price-to-earnings ratio of 23 times and a higher price-to-book ratio of 3.69 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the key factors influencing the company's financial performance. On the positive side, expansion through acquisitions and growth in global footprint are contributing to revenue growth. The increasing demand for sustainable aviation fuel, SAF, and related services is also driving revenue upwards. Additionally, the launch of new FBO locations and strong demand for Gulfstream aircraft across various customer types and geographic regions are further boosting revenue. The U.S. government revenue is expected to grow by 8% from 2024 to 2025, while U.S. commercial revenue is projected to increase by 13%. The aerospace segment growth is anticipated to be 16%, with the marine systems segment growing by 17%. However, there are also factors contributing to revenue decline. Non-U.S. commercial revenue is expected to decrease by 46% from 2024 to 2025, resulting in a total revenue decline of $52,550 million. The decrease in accounts receivable from non-U.S. government customers is another factor contributing to the decline. In terms of segment performance, the aerospace segment is expected to grow across various subsegments, including aircraft manufacturing and services. In contrast, the combat systems segment is anticipated to experience a decline in revenue. Net income and profit margins overview. The net income of the company experienced significant growth between 2024 and 2025. The net income increased by $560 million, 11.7%, from 2024 to 2025, indicating a substantial improvement in the company's financial performance. Furthermore, the net income saw an increase of $282 in 2025, representing a 19.3% change. However, it is essential to note that this growth was largely driven by an increase in other comprehensive income, which rose from $3,315 million to $21,299 million, resulting in a staggering plus 542% change. This indicates that the company's net income is heavily influenced by non-operating items. In terms of profit margins, the overall trend shows stability, with only a 1% 10 basis points increase from 10.1% in 2024 to 10.2% in 2025. The operating margin, on the other hand, saw an improvement, increasing by 30 basis points from 13% to 13.3%. Segment-wise analysis reveals that the marine systems segment experienced significant growth, with a net income increase of 25.9% and an operating margin rise of 50 basis points. In contrast, the aerospace segment faced challenges due to delayed supplier delivery, inflationary pressures, tariffs, and ongoing sanctions on Russia. Overall, while the company's net income saw substantial growth, the profit margins remained relatively stable. The improvement in operating margins suggests that the company is making efforts to improve operational efficiency or reduce costs. The company's financial performance is a notable aspect of its overall health. A key indicator of this is its ability to generate positive operating cash flow, which reflects the company's efficiency in managing its day-to-day operations. According to the provided information, the company has achieved a significant milestone by generating $5.1 billion in positive operating cash flow. This substantial amount indicates that the company is effectively converting its earnings into cash, which can be used for various purposes such as investing in new projects, paying off debts, or distributing dividends to shareholders. This achievement suggests that the company's operations are running smoothly and efficiently, allowing it to generate a significant amount of cash from its core business activities. As a result, investors and stakeholders can take confidence in the company's ability to sustain its financial performance over time. The company's debt level has undergone a slight decrease over the past year. According to various reports, short-term and long-term debt levels have been reduced, with total debt principal decreasing from $8,826 in 2024 to $8,074 in 2025. This trend is expected to continue, with projections indicating that debt will further decrease to $50 by 2026. However, interest expenses have remained relatively stable or even decreased slightly. Despite an initial increase in interest expense from $393 in 2024 to $402 in 2025, net interest expense actually decreased from $324 in 2024 to $314 in 2025. This suggests that the company's efforts to reduce debt may be having a positive impact on its financial obligations. Overall, while there are some inconsistencies in the data, it appears that the company is making progress in reducing its debt levels and managing interest expenses. The company's performance varied across different segments and regions. On the positive side, the aerospace industry stood out as a leading producer of business jets, earning a reputation for superior design, manufacturing excellence, quality, performance, safety, and reliability. This sector performed well due to strong demand for business jets. In addition to aerospace, other notable performers included aircraft manufacturing, which saw revenue increase from $5.7 billion in 2023 to $9.4 billion in 2025, and aircraft services, with a revenue growth from $2.9 billion to $3.7 billion over the same period. The combat systems segment also remained relatively stable, contributing around 17–20% of consolidated revenue. The U.S. Navy shipbuilding sector performed well due to increased demand, while combat systems military products and services in Europe also saw an uptick in performance. Canada was another region that fared well, with a low cash paid for income taxes of $98. On the other hand, some segments and regions struggled. The IT services business underperformed due to government staff reductions, contract modifications, terminations, and award delays. Saudi Arabia also performed poorly, with a high cash paid for income taxes of $59. Furthermore, foreign markets excluding Canada and Saudi Arabia collectively experienced poor performance, with a total foreign cash paid for income taxes of $233. Management is emphasizing the company's long-term value creation strategy through investments in advanced technologies, execution, continuous improvement, and being a low-cost, high-quality provider. The key to this strategy is steady development and release of new aircraft models and technologies, as well as customer service capabilities. The company is also focusing on building industry-leading franchises across business units and maintaining its market-leading position by focusing on innovation, affordability, and speed to market. To achieve this, the company will invest in innovative new technologies to modernize legacy platforms and introduce all new capabilities. In terms of growth, management expects significant growth in shipbuilding business over the next 2 decades, with a focus on expanding production capacity and capabilities to meet growing demand. The company is also investing in electric boat to support growth in submarine construction. Financially, the company's revenue is expected to increase across various segments, including aerospace, marine systems, combat systems, and technologies. Operating margins are also expected to improve, with the aerospace segment expected to reach 14% by 2026. Management is prioritizing investments in business infrastructure, products, and services for long-term growth, while emphasizing the importance of cash flow generation and cost control to maintain a strong balance sheet. The company's strategy is to maximize shareholder returns through efficient cash conversion and deployment, and generating returns from the capital deployed in operations. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $1.6 billion in 2025 and $1.5 billion in 2024. However, it is worth noting that there was a significant decrease in dividend payments in 2023, with a payout of $-1.428 million. In addition to dividend payments, the company has also engaged in share buybacks. In 2025, it spent $637 million on buying back shares, while in 2024, it invested $1.5 billion in this area. Unfortunately, there is no specific information available for 2023 regarding share buybacks. Overall, the company's commitment to returning value to its shareholders through both dividend payments and share buybacks demonstrates a strong focus on shareholder value creation. Concerns about inventory buildup or supply chain disruption are prevalent in various aspects of business operations. One major concern is the reliance on single or few sources of supply, which can lead to supplier misconduct and potential disruptions, page 22. Additionally, global trade disputes, economic disruptions, and commodity shortages can also impact supply chains, page 23. The COVID-19 pandemic has already caused significant supply chain disruptions, and other pandemics/outbreaks may potentially cause similar issues in the future. Page 25. Furthermore, demographic issues and increased demand have put pressure on shipbuilding supply chains, making it challenging to hire skilled workers. Page 32. Conflicts, tariffs, and sanctions can also disrupt supply chains, as seen with the impact of conflict with Hamas on Israel-based suppliers. Page 33. Supplier quality issues and late deliveries are also causing cost growth and schedule delays in certain contracts, such as the Virginia-class submarine Block IV contract. Page 65. These concerns highlight the need for businesses to diversify their supply chains, invest in contingency planning, and develop strategies to mitigate potential disruptions. That concludes the financial summary for General Dynamics Corporation. Feel free to comment below, and I will be happy to answer them when possible.